Everyone is pointing at the AI bubble, the shutdown drama, and the big-name sellers, but all of them missed the one quiet event that actually moved the entire market this month. And once you see what really happened behind the scenes, you're going to understand why this volatility is temporary and why it's setting up what could be one of the best opportunities we've seen all year. Unless you've been living under a rock, you know it's been a pretty wild month in the stock market. And yes, we're only halfway through it. November is usually known as a calm, friendly month for stocks. Historically, and this goes back to 1927, the S&P 500 has closed higher in more than half of all Novembers. And in the first year of a presidential cycle, the odds jump even higher. Even when the market enters November with a big year-to-date gain like we have now, it usually finds a way to tack on another couple percent. So on paper, this month should have been smooth sailing. But instead of that steady climb, we've seen markets swing around like they're trying to find their footing. And every day, we get a new storyline trying to explain it. Is it the AI bubble? Is it the government shutdown fears? Is it Burry's short sales? Is Peter Thiel selling, spooking investors? The headlines have been nonstop, but here's the truth. None of those were the real problem. The actual driver was something far less dramatic, but far more powerful. A short-term liquidity squeeze deep inside the financial plumbing. And once you understand it, the entire month suddenly makes perfect sense and actually becomes a lot more optimistic than it is felt in real time. Now, to understand where things went sideways, you need to know what SOFR represents. So SOFR, SOFR, it is basically the overnight cash rental rate for major institutions. It's what banks and funds pay when they need to borrow money for just one night. Now, normally, in a system with plenty of liquidity, SOFR stays calm, consistent, almost always below the Federal Reserve's own floor rate. That's the sign of a well-oiled machine. But this time, something snapped. Heading into the end of November, SOFR shot more than 30 basis points above the Fed's rates. This is a rare and alarming sign. A move like that tells you one thing. The big players suddenly needed cash, and there wasn't enough available. Moments later, we got confirmation. The Fed's standing repo facility, which is basically just like an emergency outlet for overnight borrowing, was tapped for more than $50 billion. Now, that facility, the repo, barely gets touched under normal conditions. When SOFR breaks structure, the repo window lights up. You're not looking at speculation or headlines. You're looking at a genuine liquidity pinch. But here's the silver lining. Liquidity events are temporary. They are mechanical, not emotional. And once the pressure releases, markets tend to recover faster than most people expect. So what caused the sudden cash shortage? Well, it wasn't one thing. It was multiple drains, all pulling money out of the system at the exact same time. First, and the most obvious one, was the government shutdown. Now, this forced the Treasury Department to build a giant cash buffer. So when there's uncertainty around these funding deadlines, they don't know how long the government's going to be shut down. What the Treasury does is stockpile money in its main account of the Fed. This is known as the TGA. And that balance surged to nearly $1 trillion. Now, most people don't realize this, but every dollar that moves into that TGA account is a dollar that leaves the private banking system. So when the TGA balloons by hundreds of billions, or in this case, $1 trillion, that is a huge hit to market liquidity. Then you layer in quantitative tightening. The Fed has been shrinking its balance sheet for 2 years. They have removed more than $2 trillion out of circulation. Now, earlier in this cycle, that wasn't a problem. After all, we've been in a bull market, and the reason is the system still had extra cash laying around sitting unused. But that cushion had now evaporated. So now each dollar the Fed pulls out comes directly from the parts of the system that matter most: the banks, the funds, the repo markets, and ultimately stocks. So what we ended up with was a Treasury hoarding cash, QT still draining reserves, and excess liquidity that was fully depleted. It was the perfect recipe for a short, sharp squeeze. But again, these squeezes don't last forever. When liquidity flows back in, markets usually snap back, often stronger than before. So once liquidity tightened, funds that rely on leverage, this is hedge funds, quant shops, CTAs, the big guys, the cowboys that trade at big leverage, they had no choice. When funding costs rise or liquidity dries up, they must reduce exposure. Not gradually, not next week, now, immediately. And here's the key. When this happens, they don't sell the stocks they want to sell. They sell the stocks they can sell. That means the most liquid names, your big mega cap techs, your Apple, Nvidia, Google, Amazon, these are the ones that get hit first. Not because their fundamentals changed, not because investors suddenly hate them, but because they are the easiest assets to unwind quickly. And that is exactly what we saw. The big dips came from Nvidia and PLTR and Microsoft. Those stocks are such a large weight in these indexes, it dragged everything down with it. I commented in a video earlier this week about how the advanced decline line is actually holding up better than the index, a sign that most of the stocks are actually okay, but the big guys are dragging it all down. So this was not panic selling. It was not forced capitulation. It was mechanical deleveraging. And it hit the big winners the fastest. So what is the takeaway? Well, whenever liquidity returns, these same mega cap stocks, the ones that have been battered by this crisis, tend to be the first to rebound. And historically, these kind of pullbacks have created some of the best entry points into these stocks. Now, Nvidia, the big king of the market, just reported earnings yesterday after the close. It beat the analyst estimates. The stock is rising, and unless that thing tanks today, we could be in for higher prices, potentially a new all-time high before the end of the year. So if you found this breakdown valuable, do me a favor, hit that subscribe button, drop your thoughts in the comments. Let me know if you think this liquidity squeeze is setting up for a big December rally, or maybe you're seeing something different. I read every single comment. Your feedback actually shapes what I cover next. And make sure you follow the channel so you don't miss the next big move.